The weighted average cost of capital, basically your all-in cost of borrowing funds across all types of financing, is necessary to know since it determines whether or not to take on certain assets or projects. So I need to know the hurdle rate or minimum return level I need to earn, and compare this to my cost of borrowing both debt and equity. The weighted average cost of capital looks at your proportional amount of debt and equity. Now remember the difference between the two. Debt has to be repaid, but the interest can be taken off your pre-tax profits to reduce your tax bill. Equity does not have to be repaid, but dividends are not tax deductible, and investors will want a higher rate of return for taking the risk of being wiped out first. We identify the returns on our various assets and projects, making sure that they generate yields similar to other instruments of a comparable risk. Well, let's look at the debt component of our financing. What is its cost after or post-tax? That depends on the tax rate in that regime. Imagine we have an interest rate of 6% and a tax rate of 35%. Then your post-tax cost of debt is 3.9%, as you can see here. Calculating the cost of equity requires a few more steps. Now, you may hear of the capital asset pricing model, so let's take a quick look at what it is. It says here that the required return on equity is equal to the risk-free rate plus the market risk premium times the beta. Well, what on earth does that mean? Let's take a look. Bearing in mind that equity holders carry most of the risk, you will want the return you can earn on a risk-free asset such as a treasury plus more. Now we come to beta. This measures how volatile a stock's movement is relative to the general market movement. So if the market moves up or down at the same rate as the share price moves up and down, then it has a beta of 1. I mean, this is a real generalization, but you get the idea. If when the market moves up and your stock really moves up faster than the market, then it has a volatility or a beta greater than 1. Similarly, if a stock drops much more quickly than the index does, then we'll also have a beta greater than 1. Now, technology stocks like Apple usually have a high beta. So when the markets are doing well, business is good and you get a nice bonus, and you decide to buy the latest iPhone. Apple sales go up. But in a declining market, jobs may be at risk and you decide, a new iPhone purchase is more of a want than a need, so you put it off, iPhone sales drop. Now, companies that have a low beta would be things like food companies, because it doesn't matter whether the market's doing well or badly, you've still got to eat, so they tend to be quite boring. In return for getting some interest, they'll probably give you a good dividend. Now, common sense says you want to earn more in a risky equity investment than in a relatively risk-free treasury bill. The market risk premium is a measure of this difference, taking into account capital gains and dividends, and it will obviously be higher in less developed markets. You may also hear or see this referred to as the equity risk premium. Now, put it all together and you get the capital asset pricing model. The weighted average cost of capital combines the interest and equity costs proportionally, identifying the hurdle rate needed to make projects viable for companies and their shareholders.